Hello and welcome to another episode of Darwin Investors. So I have a new addition to the stock portfolio this week, folks. It's a stock that I actually really like. It's one that I wanted, but I was assigned in such a way that I was told, it was like at least my understanding, that you didn't get assigned this way, but I was, so you can. And so you stick around and I'll show you which stock it was, how I was assigned, and why you don't normally get assigned in this way. And the reason why is because the person who sold it to me, it's all kind of backfired on them. So just stick around. I'll show you which stock that was and how I was assigned. But before we get into all that, let's quickly talk about if you're one of these people that your portfolio is either flat or even a little bit down for the year, and you know every time you turn on television you see the stock market just keeps going up and up and up. And the reason for this is because it's basically the top 7 stocks in the stock market that are actually more specifically the top 7 tech sector stocks that are taking this market a bit higher this year. So if you don't own these stocks, there's a good chance that you might be flat or even a little bit down for the year. So let's go ahead and take a little deeper dive into this phenomenon. So we seem to be going through a period of time right now that's a lot like the 1970s. In the 1970s, you had something called the Nifty 50. And these were the top 50 biggest stocks in the S&P 500 by market cap. And they were essentially bringing the whole market up with them, or at least holding it higher. And if you own the other 450 stocks, so even though the indices were going up, there was a good chance that you might be down. And then, of course, after the 70s, you had the 80s, and those were the Peter Lynch times, and those would be your Russell 2000 type of stocks. And, you know, we'll have those days again, but you know, he rode that wave for like 10 years and then retired, and he's looked as a stock picking guru right now. But you know, his style maybe wouldn't work today, and it wouldn't work in the 70s, but it worked great in the 80s. It'd be sort of like Kathy Wood, you know, she had her time like 2020, 2021 and that sort of thing. And you know, she was a guru for a couple of years, but if it carried on for like 10 more years and she retired, she'd be a guru as well. But right now we seem to be going through, you know, a period of higher interest rates, higher inflation, and that sort of thing. And that's making these top 50 stocks in the S&P 500 actually show a little bit more strength. So if you compare this to, say, the microcap stocks, say in the IWC, and these would be your microcap ETF, you can see the microcaps down 5% for the year, while the XLG, or the top 50, is up 16% for the year. You might also notice that they were really, really close together. You know, one wasn't really greatly outperforming the other until the Silicon Valley Bank collapse here on March 8th. And when that happened, everything kind of changed because it made it so that the microcaps, they were going to be weaker. It looks like we had a recession on the way. They're not going to be able to get any loans from these small banks. As a matter of fact, a lot of them held a lot of their money to like pay their employees in some of these smaller regional banks, and they were going through a little bit of a crisis, if you will, and having to pull their money out just to make payroll and putting it into other banks. And so when these banks crashed, the microcaps went down. So let's go ahead and compare the XLG, say, to the S&P 500 as a whole. So if you compare it as a whole, you can see the S&P 500 is up 9, but the top 50 are up 16%. If you further want to compare this, say, to the IWM, which would be your Russell 2000 stocks, you're going to see that the Russell 2000 will follow a very similar pattern to the microcaps. They came crashing down pretty good after Silicon Valley, but these are a little bit bigger stocks than what are in the microcap. The microcap would be like say 400 million market cap versus these might be in the billions. But they do follow a similar pattern in that they did come crashing down after Silicon Valley, but they are up, let's see, 1% for the year. And just for grins here, let's go ahead and compare this to the QQQ. Now, you would expect that the Qs would be up pretty good over the S&P 500, and they are. It's almost up 22% year to date. And that's because these stocks are the ones that are holding the S&P 500 up, and these are a lot of the stocks that are in the top 50 of the S&P 500 in this particular ETF. So let's go ahead and have a better look at this ETF. So this ETF, like we said, is called the XLG. It's at $318.36 a share as of today. We can see that for the year that it is up the 16%. However, over 1 year, it's only up, but it's actually pretty flat, which isn't bad for 1 year, which you'd expect that considering the whole S&P 500 has been flat for a year now. Over 3 years, it's up 42%, and over 5 years, it's up 64%. So this is a very strong ETF. They do pay quarterly dividends. 1.2% is your annual distribution yield. But more importantly, what are the stocks that are in it, and it's only 50, so I don't see any problem going through all of these. So topping the list, as you expect, to be Apple, Microsoft, Amazon, Nvidia, Google, Berkshire, and then Exxon Mobil, Meta, United Health. Of these stocks here, all of them seem to be up really good over the year, but the one weaker sector seems to be this healthcare sector. And ironically, that would be a sector during a time of recession that you would expect to be up. But here you'll notice that that's the only one on this front page that's down for the year, and it's down 7.18%. Another one that's close to even is going to be Berkshire Hathaway here. They own a lot of energy stocks. They're own, of course, a lot of Apple. They're kind of an Apple proxy in the way that MicroStrategy might be sort of a Bitcoin proxy. But Berkshire is a bit of holds a lot of Apple, but they also hold a lot of financials and they hold a lot of energy stocks. And energy is also another sector that's not up a whole lot for the whole entire year. So let's go ahead and look at the next 10 on this list. And on this next page, we would have Tesla, Johnson & Johnson, JP Morgan, Visa, Procter & Gamble, MasterCard, Home Depot, Chevron, Eli Lilly, and Merck. And again, it's a theme from the first page. We're noticing that some of the healthcare stocks, and it looks like now we're introducing some consumer staples like Procter & Gamble and Johnson & Johnson, and they're not doing that great this year. And of course, the JP Morgan is up, might be about one of the only banks that's up for the year. I know Bank of America is actually down. If we look at the next page here, we got AbbVie, Broadcom, Pepsi, Coca-Cola, Pfizer, Costco, Thermo Fisher, McDonald's, Walmart, and Bank of America. On this list, Bank of America is way down. Pfizer is way down. So Coca-Cola is pretty even. Again, the staples are pretty even for the year, and your healthcare, your pharmaceuticals, and your banks are kind of down. Energy is also kind of down for the year, although it seems to be pretty even. On the next page here, we've got Salesforce, Abbott, which again, healthcare, it's pretty even. Cisco Systems, Linde, which I've never actually heard of, Walt Disney, Adobe, Accenture, Danaher, Comcast, Wells Fargo. Interesting, Disney's actually up even through everything they're going through this year. They're actually up 18% for the year. The only one on this list down would be Wells Fargo, and Cisco Systems and Abbott is barely above par here. And then finally, the last 50 are going to be Texas Instruments, Nike, Verizon, Philip Morris, Bristol Myers, AMD, Qualcomm, Intel, AT&T, and Union Pacific. And for one, I'm kind of surprised to see AMD is actually in the top 50. I didn't actually know that. But these ones here, a lot of them seem to be down. And these are going to be your transport stocks. Of course, during times of recession, these transports are going to be hit pretty hard. It's one of the reasons why I'm not into any transport stocks. And as they release earnings, they're kind of sounding the alarm, whether it be UPS or Union Pacific, FedEx, XPO Logistics, or whatever. A lot of these logistical companies are kind of saying, hey, look, guys, we are slowing way down. AT&T is in there, another healthcare, another staple, and semiconductor stock, which seems to be kind of a mini outlier that it's only up 1.2%. I'm wondering what the story is behind that, but that would be your top 50. If we look at those IWC, those micro cap stocks, the ones that are way down, it's going to be basically a bunch of companies that we've never heard of. So let me give you an idea of the type of companies that these are. And again, these would be the biggest of the micros, and this would be Prometheus, Impinj, Transmedics, Tidewater, and you get the point. A bunch of companies we've never heard of. And then, and that's going to be a lot different, say, from what I call the Peter Lynch stocks, which are going to be your Russell 2000 stocks. And these are going to be companies that are small, but at least they're companies that we've actually heard of. And that's why they haven't taken such a beating. And some of the bigger ones here that we would know of would be Crocs, Texas Roadhouse. What else is on this list? Probably some of these cloud security stocks. You got Murphy's Oil, Matador, Wingstop. So you get the point. We've heard of some of these stocks in this here index. They're just a bit smaller. Now, just for fun, I thought it would be kind of neat to go through, you know how the 60-40 portfolio is dead. It certainly was last year. Stocks were down, bonds were down, the entire 60-40 portfolio would then be down. So I thought it'd be kind of fun to see how is that portfolio holding up this year. Now, this ETF called AOR is kind of like an analog to a 60-40 bond portfolio. You can see that year to date, this one's up 6%. If we compare this to, say, all of the bonds in the stock market, and we use the according to the aggregate iShares Core Aggregate Bond Index. The bond index is up 2.46%. So that's kind of holding things down a little bit. You know, the Fed's hiking up interest rates. As yields goes up, the price of bonds go down. It's going to hold down the aggregate. But yields have been coming down this year, so the aggregate's up a little bit. And we'll also see that neither is outperforming the S&P 500, which is sitting here at 9.22%. But I thought it'd be kind of fun to go into this AOR to actually see how they're working as a bit of a bond proxy. And the way that they do it is pretty interesting. So 1 year it's pretty flat year to date. Like we said, it's up 6%. Over the course of 3 years, it's up 14%. And over the course of 5 years, it's up 12%. Not nearly as good as just taking that new Nifty 50 XLG that we showed earlier in there. But you know, this is one of these people, if you're one of these people that wants to go bonds and stocks and you feel like this is the safer place to be, then this would be an ETF that might suit your needs. And its ticker symbol is AOR. It pays a quarterly dividend of 2% annual yield. But what's really interesting here is its holdings. And so its holdings is it's 30% of 32% of all its assets are just the US bond market, and then 32% is going to be the S&P 500. And then of course, if they try and get you involved in the whole world here, you got emerging markets, developing markets, international aggregate bonds, you know, bonds around the world, mid cap, small cap. They're trying to mix it all into this thing and give you this thing called AOR. As a matter of fact, how does that even compare to, say, VTI, which is basically everything I think in the world also, total stock market index, or maybe that's just for America. So it's up 8% for the year, and this one's up 6%. So they're pretty close, but you can outperform, looks like, this growth ETF with VTI. VTI is up for the year. It is actually down over the course of a year. Over the course of 3 years, VTI is up 39%. Over the course of 5 years, it's up 46%. Again, not quite as strong as the XLG, but just basic, not a bad ETF to get into as VTI, just maybe not as strong as XLG. So let's go ahead and take a look at my trading portfolio, and I'll let you know about the stock that I picked up, how I picked it up, and why it's so unusual. So the types of stocks that I like to own right now are the types of stocks that trade at a discount to the S&P 500. So they're a very good valuation, but they also pay dividends that are very similar, say, to short duration bonds. And I like to own the equity rather than the bond, because owning the equity gives me a chance to try and manufacture dividends as well as collecting regular dividends in order to bring down the cost basis. So if you look at my portfolio here this week, I was surprised this morning. I woke up and I got $300 from Advance Auto Parts. They pay about a 5% dividend. They paid me out, and that's pretty nice. And I get to trade options on Advance Auto Parts. So let's go ahead and look at how I'm able to use options and dividends to bring down the cost basis of stocks that I own. So we'll go ahead and look here at Marathon Petroleum. Marathon Petroleum, I picked it up for $128. The dividend works against the cost basis. Essentially, they paid me, so my new cost basis for this would be $127.25 a share. However, if you include all of the options that I've traded on Marathon Petroleum, essentially I sold a put on a Marathon Petroleum and I was given the shares. So that immediately brings down the cost basis. But my cost basis on this, and it looks like I traded quite a bit, is actually $117.35. So I've made more than $1,000 just trading Marathon Petroleum. And what this means is right now Marathon Petroleum is $122. Remember, I originally bought it for $128. And so you would say that I'd be $600 down on this stock. However, I've traded options on it enough that I'm actually not down $600. I'm up roughly $465 on that stock as of today. And so that's the way that I like to play this stock market. I like to buy it at a reasonably good price. I buy quality stocks that are trading at a valuation less than the S&P 500 that pay me a nice dividend that I can sell options against the underlying. And I did the same thing here with Phillips 66. And the Phillips 66, it looks like I was given this stock. I sold a put on it, and so it was sold to me for $104. And we'll go over selling a put in just a second. As a matter of fact, I got a whole video on selling puts and selling calls. I'll put it up here in the corner at the very end. But I sold a put on it, and I was given this stock for $104 a share. It paid me a dividend, and this is a great dividend for a stock of this price. It pays about a 4.5 to 5% dividend, and that's $105, bringing my cost basis down to about 102.95. However, if you include all of the options that I sold on Phillips 66, it looks like my new cost basis on this stock is $97.64. Currently, Phillips 66 is $99. So if it was to sell right now, like right now, it looked like I'd be down almost, $436 on this stock, but I'm not down $436. I'm actually up $136. So that's the way I like to use dividends and selling options against my holdings in a way to try and generate revenue. Another newer holding that I have here is Charles Schwab. Picked this one up not too long ago. I sold a put on this one, and I got it for $52. It hasn't yet paid me a dividend. If I include the options, however, my cost basis on Charles Schwab is actually $50.38. It's sitting here at $52.24, so I'm up a little bit on this one as well. But that's what I tend to do. I tend to buy stocks that are good value. I sell options against it, and then I bring my cost basis down. And so I don't really worry about too much about the day-to-day stock fluctuation. Now, one stock that I got really interested in was Whirlpool. And the reason why I'm interested in Whirlpool is because Whirlpool is just the kind of stock that I was kind of getting into here recently. It's the sort of thing that I think that I can make money on. And Whirlpool is sitting here right now at $139.59 a share. It released earnings this past week. It blew away the top line, bottom line. It has no price to earnings ratio at the moment, although its forward PE is 8.77, so it trades at a huge discount to the S&P 500. However, it does pay this 5% dividend. So I'm looking at a stock that trades at a big discount to the S&P 500, pays a large dividend, just beats top and bottom line. And then I think about Whirlpool, and I think about their products, and actually I think that they were kind of behind, say, the likes of Samsung and LG and that sort of thing for a little bit, but I think that they've since caught up. And then when I look at Whirlpool, I also see a company, I was like, well, what else do they own? Well, they own also Maytag, KitchenAid, JennAir, Amana, and some other things that I've never heard of. They also own Hotpoint, which I have, and Haier, which I have. And so this is a big company that owns a lot of things. However, there is no PE ratio for it at the moment. It seems to be losing money right now. And so we'll get into it in a second, but I'll show you what I did with this stock, and I'll show you how I got it put to me, and then we'll go into just briefly why it's losing money and why I think it's a good investment. So what I did this week was I ended up selling a put against Whirlpool earlier this week to try and add it to my portfolio. Similar is the way I do it to all the rest of my stocks. I tend to not really buy stocks outright. I just sell puts, and then that way, if I get it, I'm already got my cost basis down right away, and it's a stock that I like, it's a price that I like. Let's go ahead and do it. Should I get it at a price that I don't really like, doesn't really matter. I'll keep on selling options against it until I bring the cost basis down to a reasonable level. So what I ended up doing was I sold a put on Whirlpool, saying that if Whirlpool was, say, below $137 by the 28th of April, I would go ahead and buy Whirlpool for $137 a share. That's even if Whirlpool is sitting at $133 a share. The expiration date was the 28th, and the strike price was $137, and the amount that I collected was $144, meaning that my cost basis on this stock would be $1.44 a share minus 137, or 135.56, right? And so my cost basis on this would have been about $135.56. But a weird thing happened, something that's never happened to me before, is I actually got assigned this stock on the 26th of April, 2 days before the expiration date. And if you look at Whirlpool during that time, here when I got assigned on the 26th, right here at close, it was at $129. So somebody said, all right, listen, I'm looking at Whirlpool at $129. I'll go ahead and sell you all my shares for $137. And they're thinking that they're getting away with it. However, by the end of the week, it was up to $139. So they made some money. Don't get me wrong. It's like, okay, well, I'll sell you my, provided they bought it for, less than $129, they made money. Otherwise, they were losing money. But and it would have been hard to buy it at less than 129 because I think that was like a 52-week low. But any case, they went ahead and exercised this contract 2 days before they were supposed to, which is something that you're not supposed to do. And so what ended up happening was I got it for 137. It's sitting here at 139, and I've went ahead and I've sold more options against the underlying, and my new cost basis is 134.37. And that's because I just sold a call on it for $214 with a $135 strike price that expires on the 5th of May. Again, if all this stuff is very confusing, I just did a video a couple weeks ago about this that outlines this and brings it down to a lower level, and go ahead and click on that video. But why would Whirlpool have lost money last year? So what you can do is you just go over to their investor relations page. Any publicly traded company's got to show you all this. I went over here into their balance sheet on Schwab. You'll go ahead and go to the bottom here. And again, like I said, they have no price to earnings ratio. They didn't make any money last year. They lost money. Their profit margin is negative 10%. Let's go ahead and figure out why they might be down and why it's expected that next year they're going to be making a lot of money. So let's go ahead and go here to the detail view. And what we'll notice here in their income and expense report is that they have these unusual expenses that they don't normally have. Usually unusual expenses here is pretty small numbers, and if not negative. And this time they were big. They did something for about $2.3 billion, and they did something for $1.9 billion. So again, we go back over here to their investor relations page. We pull up their report. We do a search on the number there at 2.296 billion, and here's that 1.9 billion. And it turns out what happened was they ended up buying a company called Insinkerator, and they bought this for about $3 billion in cash. So they're adding to their portfolio. But in addition to adding Insinkerator to their portfolio, what they also did was they divested from their Russian assets and their Turkish assets and Chinese assets, and they sold them to Arcalix, a company in Europe called Arcalix, but in exchange, they got 25% of Arcalix's European share, and Whirlpool gets 25%, and Arcalix gets 75%. So basically what they're trying to do is kind of restructure their company, divest themselves from stuff that isn't making so much money, add a nice garbage disposal company called Insinkerator, which they already had KitchenAid, and KitchenAid makes, so they're kind of competing against themselves. One's lower end and one's higher end. Insinkerator, believe it or not, being the higher end, even though KitchenAid makes great ovens and refrigerators and what have you, but and mixers. But anyway, this was the kind of company that I felt that I really wanted to get into. And the type of thing that I'm really going to want to get into as soon as this market kind of turns around, and I got a close eye on it, it's going to be these cloud security stocks. And so when things start coming around, and you can start seeing stocks that I think that are going to be your Peter Lynch type, the type they're going to make a ton of money here going forward. I'm starting to look at these cloud security, but I'm not getting in these yet. These are money losers. They're dogs. I don't want them. But as soon as they start cutting interest rates, believe me, I got my eye on these. And so we got Zscaler. We've got Cloudflare. Cloudflare just ironically just put out their earnings. And in their earnings, they actually beat on their bottom line, and then their top line, it was a barely miss. I think, as a matter of fact, let me see if I can find it, and then we can see how much they missed by, and let's see if you can even spot it. So Cloudflare here just reported this last quarter, and their EPS was up by 135%. The revenue missed by 0.22%. And so the revenue they were expected to make 290.8, they reported 290.18. So again, this was less than this. So they says, okay, let's go ahead and trash this stock. And look at how much this went down on that small miss. So wham! So these types of stocks that are money losers right now are really out of favor, especially with the banks collapsing and with the Fed hiking interest rates and being apparently clueless as to the macro conditions that are headed down the pipeline, you know, like a train coming at them. They can't quite see the light coming at them. All they know is the caboose looks like it was in trouble or something. I don't know. They just don't see what's coming at them. They're kind of clueless right now. And for that, stocks like this Cloudflare are kind of suffering, same as the micro caps and the other Russell stocks. Ironically, Palo Alto would be another cybersecurity stock, and this one's not exactly doing as bad as some of the others. It's actually doing just fine because it's got this great PE ratio of 2,357, so it's not a money loser. So if you look at this company over the past week, it was down 5%. If you look at over the year, it's still up 31% year to date, and over the past month, it's only down about 8.5%. So it's way outperforming the other security stocks. But again, it's some of these smaller. I'm really liking some of these as a way to get into those Peter Lynch stocks when this market finally decides to turn around. All right, well, that's going to do it for this week. I did have a little bit of humor planned for the end of this video, but it's actually run pretty long. So we'll go ahead and leave it at that. If you got anything on this video, yeah, please like, subscribe, hit that little notification bell. Until then, we see you next time. Have a great day. Bye.